Hey, welcome in everybody. Listen, this is Brian with Energy Road. Today, what we're going to talk about is we're going to talk about natural gas. And is the price are we already in trouble? And by trouble, I mean it went up and actually went up to 550 and it's drawn back down to about 350. So no, those are different futures contracts and so on and so forth. But we're going to talk into the fundamentals of natural gas and where we are and what we're looking at for 2026. So are we already in trouble? Well, let's break it down and let's first take a look at where we are. Let me go right here. This is our natural gas contract by month. So for those of you that aren't aware, that there are futures contracts, which is on the New York Mercantile Exchange, which each individual month trades as its own financial product. So it kind of gives you a view into the future, and a lot of it makes sense because you have February that is a little higher, and then March, April, May, when we have lower demand, there is a drop down closer to $3. And then as we're getting into next winter, it slowly starts increasing. And it does increase later in the year, and most of that is built on power demand. But what we're going to do is we're going to talk about, is the natural gas price in trouble? So why have we gone from 550 to 350? Now, 550 was in December, 350 is today. I'm recording this on the 5th of January, so I'm recording this on Monday. Over the 3-year average for January, we're over 6 BCF a day more than the 3-year average, and 5 BCF a day more than last year. So what that means is we've had a phenomenal push this past year. But we're gonna talk a little bit about that push and what it actually means, because a lot of people misunderstand a particular aspect of it. Rigs have slowed down quite a bit, so we really have to dissect why is production continuing, and it's not because of price, it's not because of expanded drilling, it's because of dynamics that are underneath the surface. So let's go ahead and start with this. So every let me actually start with this chart down here. There we go. Okay. So every month we're declining 3 BCF a day. So if we're producing 110 BCF, which is roughly where we're at right now, that means if we don't bring on any new wells this month, then we will produce 107 BCF a day the next month. So in February. So in January, if we produce 110 and we don't bring on any, we would produce 107. Okay. The reason that matters is because we have to look at the economic engine of how much new gas is being brought online, which is currently north of 3 BCF a day. So when we're looking at how much it's above the 3 BCF, that is essentially how much we are growing or declining. Now, what we do inside of our product, Rogue Edge, is we actually dive into these charts so that we can analyze and assess them and take a look. So if we look a little bit deeper, in December, we grew by, what is this? Let me see what that number is. Let's actually see. 373 BCF a day. So that's where we grew. So that means that we roughly declined by 3 BCF and we brought on 3.37 BCF a day of new supply. Okay, and what we've seen over the last 6 months is a steady decline in rigs. So, and a lot of that is because of oil rigs. And what I want to point your attention to is this tan block right here. And this tan block is kind of your biggest contributor to how much new production there is. That's the Permian. So the Permian contributes so much of this, let's actually drop the Permian off. So without the Permian, you're less than 200 BCF or 200,000 a day. So zero point 0.2 BCF. So you're less than 200,000 a day or zero point 0.2 BCF. So what that means is the other basins don't really matter as much. And one of the key things that we're taking a look at is we're looking at the trend in the Permian. And what you can see is a steady decline, not big, but it's steady. So it's continuing to drop. And that drop is predominantly because of drops in oil prices. So what we do is we take a look at what is going to happen into the future. And if you want a convenient way of looking at this 6 BCF a day, you can actually just click in a Rogue Radar. There's a free trial down below, but you click on fundamental analysis, and right here you can see 109.9 BCF a day, 3-year average 103. Last year was 104. So it's kind of interesting to view all of this over history and have a quick comparison of that. So anyhow, natural gas production keeps adding, right? So that's one factor. Then you flip to the other side of the equation, natural gas demand. Power, it's up versus history, but it is slowing down. LNG is up, but for how long and overcrowding? Let's actually talk about each one of these individually. Let's first take a look at electric. This is something we identified a long time ago. I'm going to go back to right here. There we go. Okay. So you will see from 2021, these are all weekly, so you'll see a seasonality. And obviously, when it's high, it's because of power demand in the summer. And what you can see is a steady increase of highs getting higher and lows getting higher. So that means that there's a steady build out. So what is coincidental about 2021 to 2024? Well, it's the rise of AI. So there's more power consumption at individual computers as well as data centers. And data centers has been a big underpinning for how much demand has been increasing. But what happened in 2025 is kind of interesting. We now didn't see a real increase here, and we didn't see an increase here. So we have flattened off. So the key question is, have we kind of topped out our electric power consumption for AI right now? That's a trick question because there is a lot of renewables and there's a lot of different dynamics underneath it. It's not one variable impacting it. And it's part of the reason that we actually track electricity consumption and by source. And what you can see is that we have over the last 6 months decreased, and you can see this green section, that's natural gas. But this is by hour. You can see how much solar takes a bite out of natural gas consumption whenever it is online. Wind is pretty consistent, but natural gas takes most of the swing whenever there is an increase, because what you can see is a big increase in wind right there, and natural gas consumption went way down. So renewables is part of the equation here. So, but what we're seeing on the power side is we're seeing a flattening. Over the last 3 to 4 years, there's been a steady increase in power. So when we're looking at supply continuing to increase, power is up versus history, but it's slowing down. So the key question is, are we going to look at more in 2026? I think it's going to be more of the same. And if we have increased production and more of the same, what does that mean for gas prices? Well, it means that they will likely go down. Now let's take a look at LNG. So from 2024, let's actually take this back over time because this is always interesting to see. So what you can see here is this huge increase, and most of this coincided with capacity. As we were increasing, it had to do with particular capacity increases because LNG was needed out in the global marketplace. But there's a twist. And let me actually zoom back in here. All right. So the twist is this winter, we are getting to 18, 19 BCF a day. That is before Golden Pass is supposed to open up in February or March. That's going to add 2.2 BCF a day of capacity. So when we're looking at capacity, that doesn't equal ship outs. So ship outs are going to be super important to look at, and it's part of the reason we actually track right here in Rogue Radar, right here. We actually track what international prices are for TTF JKM. So right now, if you have, say, $4 gas, and you're only getting $9 here, well, that's not a lot because it probably costs $1.50 to liquefy it, another 50 cents to a dollar to regasify it. Plus, you have to pay down loans for the original building of the facility, fees inside the US, and fees in international destination. There's still a margin, but it is not $5. So when you're looking at this, it is a big change. So the key question is we're seeing a lot of overcrowding when it comes to LNG out there, and it's part of the reason that I have my questions when it comes to that. So let's break it back down. So production is continuing to increase. We've seen it's going to continue to increase, not by a lot, by little. So I think the 5 BCF a day that we saw versus last year, we're not going to repeat that. On natural gas demand, power is going to be more of the same. LNG, I have my questions there. So where does that leave us? The key questions: production growth. Are we still going to continue to grow? I think yes, maybe a little bit. Power demand on data centers and AI, I think that's topped out for now until we have build outs. That's going to take 5 years. So we're not going to see that next year or in 2 months. LNG export capacity. Golden Pass is opening up in February or March. That's going to be about 2.2 BCF. I don't think that's going to translate to ship outs. So, pardon me, does that equal actual exports? I think no. So, where are we today in today's market? So I'm going to walk through the bullish factors and the bearish factors so that you can weigh it for you as you're managing your trades, your hedging, your business. We're not financial advisors. Read the disclaimer below. But this is and a little bit about me. I've been trading natural gas since the mid 1990s at big shops, small shops, and for myself. So I am an expert in the field. I've been in the energy industry since the mid 1990s. So I've been at big consumers, big producers, midstreamers, trading shops, hedge funds, so on and so forth. So natural gas today, the bullish factors, storage, we're not as bearish, and the next 4 weeks are supposed to be really bearish. So we're going to shift from more neutral to not really leaning more bearish. So it's not bearish today, but if the weather forecasts hold true, we are going to be bearish in 4 weeks. Demand has been solid this winter, and Canadian imports have been solid. But 1 week could change everything. We had 1 week in January where we drew over 320 BCF a day. It was one of the biggest on record. And that changed the end of season storage projection. And we actually go into Rogue Edge on our platform here, and we have a tool where you can actually identify and see what end of season storage, which right now it is set for 1.9 TCF, which is in line with 3-year averages. But what you can do is you can actually say, well, let's say the winter demand on residential commercial is 1.25 BCF. What does that do to storage? Well, it puts us over 2 BCF. So you can use this tool to actually project and forecast. But 1 week can change anything. We're just starting January, February. Those are volatile winter months. And what we saw from all the meteorologists and the weather out there is that there is a propensity and a possibility for polar vortexes. And that possibility means that we may have more polar vortexes or no more. And if we don't have any more, I live in Colorado and I'm in a t-shirt and shorts. Well, I've got my work shirt on. Anyhow, drilling for natural gas is almost non-existent. It has to do with associated gas. And as we talked about before, there's been a drop in Permian rigs. And so when we're looking at that drop in Permian rigs, that's going to translate to less associated gas. So that is a bullish factor. Now let's look at the bearish factors. Production had a big Q4 bump. Most of the year was not very much growth. As a matter of fact, let's go ahead and take a look at that. Supply, and there we go. And let's look at January to today. So what you can see is most of the year was this 106 BCF a day, and then you had this big jump here. So there's two things going on. Number one, Q4 always brings a big wave of completions. So it's kind of backloaded. You always get a Q4 bump. You can see it almost every single year. The second thing is there's a lot of high pressure gas in Marcellus and Utica that is brought online when we have higher prices. And if you correlate this with prices, what you will see is in November and December, we saw the jump up to 4, 5, 550 even. So I expect that gas to be throttled back as we've dropped back down. So production had a big Q4 bump. I think it's going to be probably flattish for most of the year in 2026. Electric has fallen short of expectations. I think it's going to be more of the same. Canada is now competing in the LNG market. So is Qatar. Qatar is adding capacity there. So that means us having a more export capacity may not mean much. This still needs weather to pull it off, to rise in price. And the associated Permian gas is booming. Well, I'd say it's booming, it's just steady. So that is kind of the basics of where we are in natural gas and what we're looking at. I would urge you to evaluate these questions: production growth, power demand, and LNG. Those are going to be your three dynamics to watch: production on the supply side, plus Canadian imports. You gotta factor in that a little bit. Power demand and LNG export capacity. What does that do to the market? And that's going to tell you what the future holds. So listen, I'm Brian with Energy Rogue. We have a couple of products, Rogue Radar and Rogue Edge. I featured some of those today. We do have free trials on our website. You can click the link below if you're interested. But I hope this was helpful, and drop me a comment. Let me know what you think, and I appreciate it. And that's just a little bit about what I think for 2026 natural gas. So thanks so much, and I hope you have a fantastic day. Talk soon.